stock markets around the world have been anxiously anticipating the Federal Reserve's decision whether to increase interest rates or not. Currently, they sit at 0%, essentially giving free money to the banks in hopes that they will spur economic growth. The Fed has decided to once again hold off on any increase and hope that everything is fixed by the next meeting, which is in October. The world cannot sustain an increase in interest rates without a catastrophe occurring. You came here for the truth, so let me unveil that for you. We're going to get into what happened here. Obviously, a big event that seemed to go nowhere as expected. Here we go into this article, which was basically a blog of what was occurring. This is out of the Wall Street Journal, and what it's talking about is almost 7 years after the interest rates at zero, the Federal Reserve officials are now wrapping up a 2-day meeting with their vote about whether to lift rates for the first time, and investors are basically paying attention. Now, I have said this many times before that the markets all around the world are only basing their movements upon the decisions of the central banks, particularly the Fed. That's the way it works. So what they said was that the Fed managed to pull off a relatively smooth exit from quantitative easing. The lengthy process helped everyone get out of their fears of this system. This time, Fed officials certainly hope to be so lucky. What they're suggesting here is that they got rid of QE, and of course, they can get rid of the low interest rates as well. Everything is going to be okay. Well, let's see what happened. Citing global economic weakness and financial market turmoil, the Federal Reserve agreed Thursday to keep its benchmark interest rate near zero despite the rapidly improving labor market in the U.S. Well, they had to stick in that propaganda there simply because, I should actually backtrack a moment. That isn't propaganda, that is actually just straight out lying because the numbers are at 4 decades low now. Then they go on to say Fed policy makers' forecasts indicate they still expect it to be increased, but they're going to do so at a slower rate. This right here is just laughable, and I'll show you exactly why it is laughable at the end of this video, so stay tuned. Let's look at this out of CNBC. Investors will have at least 1 more month to worry about whether the Federal Reserve is raising rates. Again, kicking the can down the road. September was supposed to be the month the U.S. Central Bank finally came off its zero interest rate policy, but instead it opted to hold steady for at least 1 more month. And this is all about Janet Yellen and what she said. So we're going to move on to what I wrote about in my book, the diagram here, before we get into the importance of this. Now, this is a very simplified diagram, but let's just look at it, talk about it for just a few seconds. The Federal Reserve, the central bank of the United States, prints up the money, gives it out to commercial banks, who then produce loans for individuals. Now, what the thought is that if the Fed drops interest rates to zero, commercial banks will be more likely to get money from that Fed to loan it out to people. There's going to be more loans, essentially, meaning more things are going to be purchased along the line. More cars, more houses, and so forth. But what happens when those people aren't lining up to take out those mortgages on these big ticket items? What if there's so much debt that they're exposed to, they don't want to buy any of those other things? Well, the commercial banks don't take the money out of the Fed and they let it sit there, and we have a big problem because the Fed is left with a pile of useless garbage. That's what's happening right now, and this has become worrisome. If you had higher interest rates, you have lots of people depositing their money into the bank, their savings accounts. You'd have a good a good thing, at least for temporary, and it has to be balanced. Of course, you don't want too high of interest rates. That could hurt people. And there's a reason why you increase the interest rates, because of inflation. And there's so many factors. I'm not going to get into that here. I do so in my book. But basically what I'm trying to say is that we've basically backed ourselves into a corner and they can't get themselves out of it. Fed watching China and emerging markets closely. Yellen says a slowdown in China in itself is not a surprise. A hard landing, though, would be. The risk is a more abrupt slowdown than most analysts expect. Developments that we saw in financial markets in August reflected the concern that there was about the Chinese economic performance and the deafness with policymakers addressing these concerns. This is Janet Yellen talking about this. She's concerned about China. But a lot of this, is about pointing fingers. The Fed points the fingers at China. China points the finger right back. Lots of information actually in this article out of the Telegraph, and it's trying to get to the bottom of it. Of course, it's very surface level. Right here, another Telegraph article. The Federal Reserve is not expected to pull the trigger on an interest rate rise until next year, in the wake of a global stock market sell-off triggered by the economic turmoil in China. So once again, China, it's your fault. That's what they're saying here in the mainstream media. The U.S. Central Bank held fire on its first rise in more than 9 years as it admitted that uncertainties abroad had made it more risky to tighten policy. That's what they're saying. We can't increase the interest rates. Look at what's happening in China. They can't get a handle on it. But the fact remains is that if it's not Europe, if it's not China, if it's not the US, if it's not somewhere else, then where is it? It's always happening somewhere in the news. There's always much to talk about because all of these nations are facing some sort of problem at any given time. So, again, more information in here, but I want to move on. This was just recently, a few days ago. Wall Street now sees a September Fed rate hike, according to this CNBC survey. Well, unfortunately, they were wrong. And let's turn back the pages of history to an almost very similar article. Check this out. This is back from 2012. Same survey here. Fed will have to raise rates before late 2014. And let's see if I bring out my calendar. It's 2015, but they said it would have to be before 2014. Well, I guess they made a mistake. And then look at this here. Fed will raise rates faster than investors bet, according to this other survey. This was back in 2014, June 2014. And once again, they were wrong. So what is the problem here? Is that they can't raise rates. The Federal Reserve will not raise rates until they're ready to crash the economy. Now, of course, they have the option. If they increase it, let's say, to 25 basis points, or let's say 0.25%, which seems to be a likely scenario, they can always just bring it back down at an emergency meeting and just get that rate to come down very quickly. So they have that option there, but they're not even taking that. So I see this as a very big problem because when you have these loose monetary standards, you cause a lot of distortions and dislocations in the market. You have a lot of volatility. You basically have a lot of problems, and that cannot be solved by the same problems magnified. You can't add more debt onto it and expect it to fix the problem. It just doesn't work like that. If you found this video informative, please give me a thumbs up. I'm really trying to get back to the comments and to the emails. There's just so many pouring in. I am reading your comments and your emails, of course, and I'm trying to reply back to them within the videos that I do. So please stay tuned to all the videos and you will get your responses in this way. And I will try to get to as many of the comments as possible. There's just thousands and thousands. It's so hard to get back to them. Basically what I do is I try to reply to the current day's video as well as the previous day if I can. Any more than that, it's just so hard to get back to it in time. So I wanted to let you know that. And last but not least, If you found this video informative, I know you'll find my book, The Money GPS, even more informative. You can actually flip through the book. If you go over to Amazon, they have this look inside feature, which allows you to flip through the book and see if you like it for yourself. Take care.